Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. $11 a.m. on the East Coast, the 9th of April. We got a real humdinger going. Guy Adami, Dan, Nathan. If it's Wednesday, yes, it is Butters, bitch. So we're going to have a little John Butters worked in. You got to be faster than that. You got to feel me coming.
Dude, you were coming in hot. I'm not getting in there.
I am hot. I'm hot.
The way of that juggernaut. Where risk meets opportunity, guy. Normally, when we hear that line,
Laird Hamilton, I think of a surfing Mavericks.
By the way, that CME Group commercial is all time.
Badass.
And by the way, our friend Anita Letsky, in her office in CME Group, she has a full-size cutout of like Laird. Yeah, we FaceTimed you once from in there. It's amazing. It's amazing. Guy, to you
hope
right
he has
now,
clothes on. I mean, is it a dressed Laird Hamilton?
Probably has. Yeah, he's dressed.
Okay.
Is risk meeting opportunity right now? Is risk that is in the markets that is unquantifiable? Let's be clear about this. All right, let's go back for a second. We're just messing around there. You and I have sat through, and I think we've done this a little bit. We sat through the dot-com implosion, which led to a recession that got to 9/11. And I think the 9/11 aspect after it was obviously the most uncertain part, right? You get to the buildup of the financial crisis, until Jim Cramer says they know nothing. That's what somebody's got to do that. They know nothing. That was the summer of 2007, by the way. Okay. And then obviously things got crazy in 2008, and it was a pit of despair. No one knew where that was going to go. COVID, same thing. Are we on the precipice of a moment like that? In your opinion? We've lived through them. It felt really scary. You know what I mean? Now everything comes back sooner or later, but it's that feeling right now. Is risk providing opportunity, Guy?
So it's always different, right? And we had a podcast earlier today where we spoke in a little more 30,000 feet. We'll get a little more granular here. But all those things you just talked about, there was a different set of circumstances. The set of circumstances now are around credit markets. And, we're going to look at different things today without question. But last night, I stayed up late to sort of watch a move in the bond market that, quite frankly, I don't think anybody has seen in quite some time. A week or so ago, maybe 3 or 4 trading days ago, maybe a little bit longer than that, you had a 10-year yield, Dan, that traded down to 3.8%. At its peak last night, we had a 10-year yield that was either side of 4.5%. And we're talking about, by the way, as you know, this is the United States, the largest economy in the world. Theoretically, the most liquid security in the world should be bond, 10-year, 20-year United States treasuries. And that is clearly not the case. So something is going on. There's some mechanism at work right now that I think has gotten the market a little bit concerned. And I think one of the reasons you still have a VIX that's either side of 50, which, by the way, historically doesn't remain here. It could potentially trade here, but the fact that we've been here now for a period of time should really be raising some eyebrows. So is it different? It's different in so much as the mechanism behind it, but we have seen different situations like this over the last 25 or 30 years.
Yeah, let's go to the 10-year yield chart that Amanda just had out, but let's do like a 5-day or something like that. Because I want to ask you something. This is a market that you know far more about than I do. So if we do so overnight, let's do a one day now, Amanda. I'm sorry if you don't mind. So overnight, you had that ramp to 4.5%. All right. So is that when yields are going higher, that assumes that bonds are going lower, right? So that inverse sort of thing. And then you see this stabilization, you see it come in, right? And you see it kind of stabilizing now back at that 440 level or something. Could there be something where the Japanese and the Chinese are selling overnight and we come in the morning and try to stabilize? Or is that too are we getting too, cute?
No, I don't think you're getting too cute at all. I think there's clearly something like that going on. There are other things at work. I mean, there are a lot of people talking about something that's far too arcane for us to get into, but it revolves around sort of the repo market and what's going on there. But I think your point is well taken. When you're talking about the Japanese, which I still believe are the largest holders of our debt, and then China being number 2, and given what's going on in terms of tariffs and stuff, I mean, reciprocity suggests you could see things like this. By the way, we've talked for the potential of that to happen. So it's not like we're talking in a vacuum here. So I think that's some of that going on. And I think the stability that you're talking about right now could be coming in the form of some other things at work. I want to be crystal clear. And, I don't want to be ambiguous at all. I am one of the few people that still think yields are going significantly higher for the wrong reasons. I've been smart. I've been wrong. I've been dumb. It's going back and forth. And that chart that we just had up suggests exactly that. The bond market is trying to figure this out. But when you look at things in the aggregate, there's some things going on without question that I think the market should be concerned about.
By the way,
there's an auction today too, I believe.
Yeah, and we had a bad auction last week. What maturity
we
was
had
that?
a 3-year auction yesterday, I think. But yeah, so don't at me if I'm off, but I think
you're always too hard on yourself. You use the D word, dumb. You're never dumb, guy. You're very transparent. As somebody else who's very transparent, I got to give him a shout out right here, because Doug Cass, Seabreeze, writes for thestreetpro.com. He documents everything he's doing. He's been trading this market fairly brilliantly over the last sort of few weeks, and he documents it right there on Street Pro. So go check that out. But he just sent us a note, guy. I suppose we're rapidly approaching the moment where we find out whether they're just playing insane or actually insane, which brings us back to what we started talking about is like, this one seems very different than these last three instances that we mentioned. These things came from nowhere. This was kind of telegraphed. People discounted, right? Like in which they were like how insane they were going to be. And now it just seems like there is no walking back of anything. It seems like any opportunity that folks think they've opened the door to kind of tamp down worst case scenarios, then they double down. Like, so for instance, they're going after chips, they're going after tech, they're going after ag, they're going after all these things. And then all of a sudden now last night, Trump talks about we're going to have new tariffs on pharma. So that's another sector in the market that gets hit. It's going to have economic ramifications the way folks are thinking about this. So they never dial it back at all. They're like at 11 and they're staying at 11.
Yeah, we're definitely at 11 right now. And I think your point about how does this get ratcheted back, I think it's going to come in the form of something that's probably, I don't know, there'll be some half-truths around it, if I can be so bold. In other words, we just got a call from President Xi, or we just got a call from Vietnam, and they will say, they've been willing to make some, they're willing to negotiate. And although we said we wouldn't negotiate, they're putting forth a good faith effort and those types of things. So they'll try to find an exit ramp, which looks like we didn't acquiesce, if that makes sense. But I don't know if it's really out there. And I think when you've dug in as much as you have dug in, it's really tough to sort of extricate yourself from that. So, yeah, I fear that this is going to last longer than people think. And again, with a VIX at 50, I think the market's coming to the same conclusion.
All right, let's pull up the S&P 500 futures here, the E-minis guy. You and I, we get lots of questions from folks, friends of ours, again, who don't stare at their FactSet machines all day long and the like. And, for us to send them pictures is not always that useful, but a lot of folks who watch, Market Call and listen to the Risk Reversal podcast, they're very used to this as an interesting input. I think the speed in which we've sold off, from that kind of 5,800 level over the last week and a half or so is something that's it's very concerning. I mean, it's just concerning because you get other market dislocations. We've already talked about in the treasury market. One thing that's interesting, and I mentioned this on Fast Money last night, we don't really have to pull it up, but you talk about the VIX. The VIX is a measure of volatility in the S&P 500 index. There's this MOVE index, which measures the volatility on the treasury markets. And that thing is at 52-week highs. That thing looks exactly like the way the VIX has spiked, which is obviously, contrary to what's going on here. You look at this thing and you say to yourself, let's make it a 5-year for a second. We talked about Carter's work over the last couple of days where he showed us the uptrend line from the 2020 lows and where it, kind of met all these levels. You look at that that moving average. That moving average is not the correct moving average. If you want to just take that off for a second, because it's much, there you go. We're at a point here, guy, and I sent this, you were in the chat, to Carter and Danny and Vinny and Porter. You go through this prior high, you know what I mean? Like, that 2021 high. Here, make it a 5-year, please. There's an air pocket down to like 4,100 or something like that. So from 4,800 to 4,100. I mean, I don't even know where the support is.
The problem is right now, we should have, and yesterday it appeared as though we were going to do that. And, if Amanda wants to draw that uptrend line from 2020 if you want to do longer term. I mean, draw it again just so people can see. I mean, we should have bounced a lot more aggressively than we did. And it certainly appeared yesterday that that was going to happen. And then the fact that it gave it all back as quickly as it did, and I think a historic reversal in terms of the Dow Jones, which I know we don't really look at, and the S&P. I mean, that should be worrisome. Now, okay, you want to give it a day or so. Maybe today's the day that we get the bounce. We'll see. But there's no indication right now that that's going to take place. That should worrisome. And I'm not trying to scare anybody, but historically, when you trade down to a trend line or trade up to a trend line of a 4.5, 5-year duration, the first time either up or down, you'll get the sell-off or the bounce. In this case, you should have gotten the bounce. The fact that we did yesterday and gave it all back, I think is a little bit alarming here, Dan. And again, I'm not trying to be too hyperbolic, but it's clear that the market sort of rejected that move pretty quickly.
Yeah, I agree with the kind of notion that, rallies are to be sold. A lot of that has to do, and you and I have been talking about this on the pods for a little bit now, is the lack of confidence in the intention of the policy, what the outcomes potentially are. There's a lot of folks who've been saying, and I guess it's kind of been chattered a little bit, whether it's leaks or not, is like a lot of these trading partners, whether they ally or foe, they're kind of perplexed here. They don't know what the administration wants, right? So the blanket tariffs, and then the country by country with the funky math and this, whatever. I'm sure there's plenty of countries that would love to have these conversations, right? But they're not going to negotiate against themselves, right? Like, so the idea that, okay, you want, different trade barriers or this and that, or, whatever down, but the idea that they want to push for changes in the way that they tax their goods over there, whatever country that is, or block like the EU, and getting rid of the VAT and stuff like that, it just seems like, oh man, this is not going to resolve itself particularly soon, because there's no sort of continuity, right, to the policy and then what the expectations are in return.
Without question. And, again, it comes back to some of the questions we're getting, about bond yields. And one of the things that we talked about, if you want to put John Hutton's question up, Amanda, just to take a look at what people are talking about, what are your thoughts on the 10-year auction today? How much damage will a weak auction do in the short term? Bond auctions are all about confidence. And when the market lacks clarity, the market lacks confidence, my instincts suggest it's going to be a pretty miserable bond auction. So can I see a further weakness in the TLT on the back of that? Absolutely. Will some force step in to sort of make this thing, to sort of paint the tape, as they say? Perhaps. But these auctions take on a really heightened sense of importance given what's going on, without question, Nathan.
Yeah, man, I don't know if you can pull up that move index versus the versus the VIX, because I just think it's really interesting. And again, it seems like the market is coming around, or market participants or the media is coming around to this kind of yield move. I think it's something that if you've been listening to Risk Reversal Pod or Market Call or Guy on Fast Money, this is something that he's been harping on. And you often, over the last, call it, I don't know, year or so, you preface the comments like, no one really cares right now. That like, you know what I mean? But this is something worth keeping your eye on. Yeah. Not too different the way you were talking on the weakness in the one, that sort of thing, going back, a year ago. Good on you. I mean, I can go deep on this stupid generative AI stuff. You can go deep on the stuff that's probably more important for the mechanics of the market. Here's one. I just want to pull this up, Guy, because I was on the desk with Carter last night. He was sitting in your seat on Fast Money. You had something more important to do, obviously. I pulled up this 10-year log chart of the stocks. Now, yesterday, you looked at the SMH. You had been saying for a while after that breakout that you thought there was a chance that would round trip the whole thing because of the SMH and the construction of it, which you and I kind of think sucks between, Nvidia and Taiwan Semi. Just look at this stocks. This is a log chart. This is 8% Qualcomm, 8%, Nvidia, 8%. Taiwan, you know what I mean? Like it's much more evenly weighted. Now, obviously, the top 10 have. Look at where this thing is.
There you go. That's from 2016, by the way. And, that's Amanda doing it on her own, and she's visualizing that. But that's a 7, 8 year, 9 year trend line. So that is, again, the longer the duration, and I know you know this, but it's important if they're new listeners or viewers, the longer the duration of these lines, the more important they are. Now, theoretically, like the S&P, We traded down to it, and we're trying to bounce here. Let's see. But, if you get a week or so of not being able to bounce, just time decay alone will get you through the line to the downside. Now will happen both the S&P and in this stocks as well. So I can't overestimate or over sort of state how important these levels are for the short-term health, at least, of these broader markets.
Yeah, and we bring that up because obviously Nvidia, a huge, outperformer for the last few years, really until it stalled out on a relative basis, 6-9 months ago or so. Last year, the performance of Nvidia, and a lot of it happened in the first 9 months of the year, or 7 months or whatever. 25% of the S&P 500's performance last year, when it was up 25%, was Nvidia's performance. So that's why we spend a lot of time talking about Nvidia and the semis. And, semis were obviously meant to be this kind of, focal point of this generative AI trade, and kind of like what it could be based on, listen, Nvidia went 4 years ago from having $20 billion in sales, less than that actually, to expected $200 billion this year. I mean, just think about that. We've never seen anything like that in such a short period of time. And the other thing is, that sucks. If it were to go back to that prior low, if you looked at that, this is going back to, I don't know, 5 years or something like that. If you just want to do that again, with that uptrend, guy, that's $100.
Yeah.
I mean, that's $100. The SOX is trading at 157. Now, you may say to yourself, you're fucking crazy. Like, that's not, dude. Nvidia went down 70% from its highs in 2021 to its lows in 2022. Meta went down 70%. Tesla went down 70%. Netflix went down 20% or 70%. These are all, the best performing stocks. And you could say, well, that would be crazy. It's so different this time. I don't know why people don't think that these things can be cut in half very easily.
Well, that leads us to this question from Russell Cameron Thomas. I love people with 3 names. They typically are assassins or people that have killed, for example,
by the way, you got a snicker out of Bill over here.
Well, he knows that I'm right.
He might use that one.
Yeah, he can use it. But Russell Cameron Thomas is saying, given many companies will be forced to absorb tariffs, aren't they going to cut costs elsewhere? And we have talked about this. You've used the term. I've used the term. The sanctity of capex has to be in question in the environment that we find ourselves in. So although people have said they're going to spend, and they said, regardless of the environment, we need to spend in order to keep pace and outpace our competitors, you got to start to wonder whether or not all the capex that's been thrown out there around AI is actually going to be substantiated, or people are going to start to back off. I think the market is not talking about that. I know we have, and I think more and more people are going to start to come around to that potentially being a bit of a headwind.
By the way, we're already starting to see that. About a month ago, into this CoreWeave IPO, there was plenty of reports that Microsoft was canceling leases, pulling back, that sort of thing. And, the year-over-year increases in CapEx from the major hyperscalers had been, decelerating massively to like kind of mid-single digits or so. So at some point, if you are one of these companies that relies on advertising, very cyclical, right? You're Amazon, and North American retail sales, a big part of your sales growth. And obviously AWS is all your margin, but that deceleration's happened. The investments that you've made in your cloud to have these models there to service your customers, you know what I mean? If that starts to slow, because of this cyclical sort of situation, however you get your consumer spending, your advertising, whatever the hell it is, they're going to cut capex. It's just that simple, and it's not too different. Meta did not bottom in 2022 until they started rationalizing costs, which meant firing people and cutting other costs. And so that's just going to happen. I mean, I don't mean to sound so certain, but it's just, this is where the folks that have been so invested in these narratives, whether they're on TV or, you know what I mean, whatever, on Twitter or this and whatever, they double down, and then they cry at the fucking bottom, man. They call themselves suckers and this, that, whatever. They fell for Jensen's bullshit, hook, line, and sinker, right? I mean, get in here because I'm sounding a little aggressive.
Well, no, I mean, listen, my view on this. People say I was a hater, and I will tell you that there was twice last year where we pointed out the vulnerability of Nvidia on a technical basis, and both proved to be correct. This time, we've been pointing out the vulnerability of Nvidia not only on a technical basis, which what we saw in January, but on a fundamental basis as well. And that came in the form of the last quarter when margins disappointed. Now, the optimists will say they told you that margins were going to disappoint, and that's fine. They also told us that you're going to see a reacceleration in the second half of the year. That's hope, I believe. And again, you say it all the time. Hope is not an investment thesis. So the fact that Nvidia has gone from 150, and how low did we get the other day? Did we have an 80 print or something like that? You probably have it in front
I
of
think it
you.
was like 80, 86, like intraday.
86. I
Yeah.
mean, so let's say it's down 40 something percent. That's a
Yeah.
pretty significant move. So at a certain point, you can say, you accumulate, own, don't trade, all those different things. But when a stock has a move of this magnitude, at a certain point, you're just flat out wrong. And I think that's what's going on here.
You know what a great example of this guy, and I don't know if we mentioned it like this. Okay, see that gap in late January? You and I were down at iConnections in Miami. That DeepSeek, data came out overnight, and a lot of folks, Nvidia closed down 17%. The stock had a $3.3 trillion market cap heading into that day. It lost 17%, closed nearly on the lows. Look at that. So a lot of the analysts, investors were freaked out at first, and then a lot of the analysts who know better, you know what I mean? Like they know better about the fundamentals, said, oh, no, actually, this is good. Mm-hmm. Investors bought it. It filled in that gap. Then the company started, we started hearing the capex from their major customers. People were unimpressed for the most part because they saw revenue decelerating in their cloud businesses, but cost still going higher. So that's kind of been the story. And, you've seen cancellations of leases. The CoreWeave thing was a freaking disaster, in my opinion. I know it rallied a lot, became a meme stock for 2 weeks. It's right back at its IPO price or just above it. And so all of a sudden you say to yourself, okay, if we've not priced in any revenue deceleration, there's still plenty of analysts who think that the numbers are still low for 2025 and 2026. So again, to me, I don't know. There's no reason why this thing couldn't be cut in half because the sentiment was so tight in this thing. There's so many folks who have yet to capitulate on this thing.
All right. So one of the bear cases that I've had, and it was right, wrong, like most things, was that although price to earnings Nvidia was not only fair, but probably cheap given their growth, their price to revenue didn't make any sense. And I've been saying that they've been out earning their revenue stream. And at one point, I think at its zenith, Nvidia was probably trading like 24, 25 times revenue, which is insane historically. Right now at 90, or where it's currently trading, I think you probably have in front of you to the penny, it's a $2.5 trillion company. And next year they're expected to earn $250 billion. I'm rounding down a little bit for the sake of math, which puts us at about a 10 times revenue. I will tell you that sounds reasonable. And I think you know this better than I do. Historically, that's still probably high by a couple different turns, but it's far more reasonable than it was. If this were to get down to, let's call it 6 times revenues, that's a level where you could say, okay, this is starting to make a little more sense. But even despite the move on a historical basis, Dan, although cheaper, it's still not cheap.
Yeah, so for fiscal 2026, that's the year we're in right now. Expectations for revenue growth are 57%. All right, good luck with that. And then 2027, 23%. So Gene Munster, who I love, great friend of the pod, and I think he's a brilliant guy. He thinks that those numbers are low. He thinks that they come in above that. He thinks the 2027 number could be 30%. Okay, that's fine. A lot of the kind of bull case will like, this is not just a hardware company. You know what I mean? It's a software ecosystem and the like, and that's why they're able to have the sort of margins that software companies have. But I think your point is a really good one because if there's less adoption of their chips, if the revenue growth comes in, then the margin they're able to get from the software component, because it's going to be used less, is going to come in too. So, like your point is a great one. 12 times sales this year, 10 times next, trading on a PE basis at 22 times, this year, and 17 and a half next. This might be the best buy in the entire market if you believe that that current consensus estimates are going to hold, and then maybe there's upside. And maybe this is the digestion phase of this, huge build that we've had for 2 years. We've had $750 billion in capex spent on building these data centers and trading these models and buying all the, the servers and the chips and the memory and all the stuff that goes in it, and then training of the inference model. I get it. It might be. That's why we're going to keep a really close eye on it. Maybe at $80. This is like, you know what? You hold your nose. Maybe it goes down. $80 is like basically 50%. Guys, if you look
Yeah.
at the 52-week low, I think if you get there, is that a 1 year that we have there? Yeah, just back it out one more month. If you get to the 52-week low, I think peak to trough, guy, that's about 50%. And I know that's not a magic number, but at that point, it's discounting a whole heck of a lot.
No, I agree. And but then the next question is, and I don't want to get bogged down here too much, but the next question is, will you once again see the type of rapid stock increase that you've seen over the last couple of years? And my instinct suggests probably not. This is going to become a mature company where you don't see the moves of the magnitudes that we've seen before. With that said, I think the call of the day is a good one. Good for Jeffries, by the way, who's basically been underperform, I think, for a long period of time. They just upgraded Apple to hold. So they've done a really good job. So a lot of times I'll get on analysts, but this time I think, good for Jeffries for sticking to their guns. And now we've gotten to a level where they say, okay, we're going to put it to a hold. You can see the average price target, according to FactSet, I think it's about $245, give or take. The high in the street is sort of pie in the sky, I think 308. And the low is, oddly enough, where we're probably traded down to an Apple. So good for that analyst with a 170 handle, because I think at one point today we were trading around 170 or so.
This guy on January 20th, okay, when the stock was $201 or something like, oh no, it closed. You ready for this? It closed that day at 230. He downgraded the stock.
Good for him.
Hold, sell. I mean, that's a heck of a call, and it also takes some cojones to say, okay, like I'm going back in here. Now, listen, he's at a hold. He's not like, I could have seen a double upgrade on this thing. If you nailed this from 230 down to, 175, you might want to go to a buy here. But again, that leads me to believe that he sees more down. Let's go to a 5-year chart for a second. This is one of, like, we've been saying this a long time. This will be the last battle fought within tech. And it's also going to be one of the most important components of a trade situation, whether it's a tariff situation or a trade war with China, because 95% of the iPhones that are made in China. They're trying to push some, kind of manufacturing over to India. It won't be enough. There's supply chains that Tim Cook has basically created. And not only has he created for Apple since the late 90s, because that's what his job was before he became CEO in 2011, but he also created a model for the US tech industry on the hardware front to do the same sort of stuff. That's why we have such a huge dependence for consumer electronics on China. So thanks a lot, Tim Cook. Tim Cook is also the guy who kind of, tail between his legs, I'm assuming, went to the White House and talked about $500 billion in manufacturing that they're going to, or infrastructure build over the next 4 years, guys. So he said this in January, the next 4 years, 4 years, we have an election, that sort of thing. I mean, what a feckless, dude, in my opinion. I mean that sincerely. They stand for all of this social stuff or whatever, they were all like flying the flag, DEI, ESG. They pull it all back. They say, we're going to spend $500 billion over the course of your presidency, dear leader. But you know what? Please exclude us from your trade war. That's and then on the flip side of that, he's doing the same thing to President Xi, because he spends a lot of time in China too.
Yeah, no, it's unfortunate, but that's the world we live in. And what they will say behind closed doors is we have a fiduciary responsibility to our employees and our shareholders. And this is unfortunate part of that equation. With that said, another good for Jeffries, because they just did the same thing with Starbucks, which, by the way, has been a disaster. We've round-tripped the move since they brought in the Chipotle CEO. If you go back and look, I think it was last summer, if I'm not mistaken. What was it, Dan? I want to say August or so they made that announcement.
Whatever that big gap is.
So here we are. And and Jeffries comes out and says, you know what? Here's the time to sort of not be as cautious as we've been. So I want to give Jeffries a little bit of shout out today on both of those calls.
Yeah, just obviously the fundamentals of this company are in flux, right? They have to fix their US business in particular. I think that's been a problem, but China has been a huge growth area too. So we haven't even mentioned this as it relates to Apple and then a company like Starbucks, but obviously a company like Tesla. When you are a huge multinational, you're like literally deemed to be a national champion of the US. And I think we could say that about Apple and Starbucks and Tesla. you're going to face some nationalistic tendencies as far as buying in a heightened, kind of conflict like this. And we've already seen it with Tesla in Europe and also in China. And so this one could look interesting, guys. They got to get a lot of things right. Valuation is still kind of funky, but which leads me to McDonald's, because this is a name that you have liked a lot for a whole host of reasons, both company specific, but also where they sit as it relates to a consumer. This is a good looking chart, man, like in a funky market.
They're hanging around. They're hanging around despite this market turmoil. I mean, McDonald's, I think a lot of people would submit, has hung in there pretty well. And I do think, McDonald's is sort of the Walmart-ish of the fast food world. They win to just about every different environment. And this is one of the environments that they theoretically should do well in. I mean, they're not going to be listen, on the tariff front, I mean, obviously they're going to be affected. They're going to be impacted. I think the fact that egg prices have come down, believe it or not, a bit of a tailwind for them, given the amount of eggs that they buy. But with all that said, McDonald's continues to be sort of an outlier out there in a sea of red over the last week. McDonald's has hung in pretty well. So I continue to like it. When will I get concerned? Well, we break the 200-day moving average. Let's have a conversation. But until then, I think it's full speed ahead with MCD.
Yeah. I want to go back really quickly before we hit some butter stuff here. I want to go to the S&P futures one last time here, guys. So they're trading at 50.45 here. Let's just pull up a 1 year, then a 2 year. I know we looked at this. What are some levels? All right. Tape bombs are going to happen, right? You're going to get and you said it could be, it could be not be true. Like, you know what I mean? Whatever comes out. And we saw that on Monday, right? There was some Fugazi, announcement in the market reality. If you're looking at this, okay, we're through the 52-week lows. We pierced through that 200-day moving average, which really served for the last couple of years as a really nice uptrend. Let's go to a 2-year chart for a second here. If you're looking to say, I think by the weekend, we are going to get some headlines, because people are not going to want to go into the weekend long, right? If you think about that. But if you think you get something to kind of help put in a bottom, where do you put a stop in? I know this sounds stupid. Is it 49.99 in the future? You know what I mean? Like, is it right below a big round number if you're looking to kind of take, define your risk to some degree? And by the way, when you're using stops, if you have like a gap or something like that in the futures, your stop will go off at, let's say your number was 49.99 or something like that, just below, but you might not get filled until lower than that. But at least it's giving you some sense of kind of what your kind of stop out level is. We are in a market, guy, where you could see some really gappy action. When you see to the downside, you go through these circuit breakers, they stop. You know what I mean? Sometimes you just go right through them when it reopens, that sort of thing. But in this environment, you know what I mean, where we are right now, if you're looking to play for a bounce, what's your target? Where's your stop, and what's your target on the S&P?
Well, I mean, the other day, we said I thought 5450, 5500 on the bounce off a trend line. I'll stand by that, despite the fact that yesterday's action was not good. So I think that's right. On the downside, it's one of two things. It's either the recent low, which I believe was like 4840 or something in the S&P, or maybe today's low, which was like 4950 or something. So you pick. But it's in there, understanding that a lot of people are going to be setting stops there. But what I will say is this: with a VIX of 50, and there's something in our world called negative gamma. The lower things go, the more accelerated the selling becomes. But conversely, when the market starts to move to the upside, the more accelerated the buying comes. So we saw that a little bit yesterday to the upside. We really haven't seen it in earnest. I don't know what the headline is going to be at a 50 VIX to sort of get that in motion. But people chase their tails in an environment with a VIX north of 25, and now it's twice that. So just be prepared for exaggerated moves up and down, Dan.
Yeah, and again, you may say, all right, so on a the S&P futures, they're trading at 50.41 right now. 41 on the E-mini. It's like that's a reasonable sort of thing. But I just wanted to kind of get those levels out there. In my opinion, if you're setting your stop, down 100 points on a 5,000 sort of number,
listen, I agree. But listen. That's the bands that we find ourselves in. Peter, by the way, Peter Gishtland, I'm sorry if I butchered you.
Peter, he's here with us a lot, Peter.
So his question is a good one. If we go into a recession, by the way, there have been people that said we're going. I have no idea. I have my views. It doesn't matter. What's the right multiple? And is a 15 multiple ridiculous? Not really. I mean, we've seen multiples there before. The real question is not necessarily the multiple, but what are earnings going to be? Because now you put a 15 multiple on sort of a 250 earnings and you're still below 4,000. So you better hope that earnings for some reason hold in, and then you want to start to tweak, call it a 16 multiple on 250. Maybe that gets you your 4,000. But yeah, I mean, I don't think that's unreasonable, Dan. I mean, not at all.
That's what we call in the biz, guy, a great segue. Thank you for the question, Peter. If it is Wednesday, we get a preview of FactSet's earnings insight blog. It drops every Friday morning. You can have it in your in your box, in your email box. Go to insight.factset.com/subscribe. Our main man, John Butters, who's the senior earnings analyst over there at FactSet, he writes the report. Like I said, we get the look of it. Let's go through this because this is kind of what Peter was getting at. All right. So based on Monday's close, guy, the forward 12-month PE ratio for the S&P 500 is 18.2%. The PE ratio is below the 5 and 10-year averages, but still above the 15-year and 20 averages. This is also the lowest forward PE ratio for the index since November 2023. All right, let's talk about this for a second, because if I have it correct, in 2022, when the market was in that bear market, we still had that same concentration, right, of the top 10 stocks, and they bottomed out somewhere, I want to say, in like at 20 PE. But the other 490 got down to a trough multiple. And what do we mean by that? Over the course of history, when you have these bear markets, where does the S&P 500 trough? And that's, I think it was like 13 or 14.
Low teens,
so you could say to yourself, that was about as good as it gets, especially given the concentration. So sometimes it helps to kind of back that out. So now we're seeing a 12-month, at least what Butter's seeing from his work, at 18.2. Are we almost there yet, including the concentration of the top names?
I think you can definitely overshoot to the downside. I mean, we've seen it before, and I think I understand the environment we're going into. Maybe I don't fully, but if 60% of what I think is happening happens, yeah, I mean, it's reasonable to think you could see a multiple in the S&P in the mid-teens. Again, 14, 15, 16. Do I think we're going to 12? No. But I do think a mid-teens multiple is not out of the equation. But then you have to ask yourself, right, what's going to be the earnings on the back of that? And it's not that simple a math equation. I get it. But back of the envelope suggests, 15, 16 on 250 of earnings-ish. And then you get yourself down to about, 4,000 S&P. And you say, all right, you want to bake in a little bit of fluff on the upside, 4,250. But my point is there's still potential for downside despite the fact that we sold off considerably. The question is, do you get a bounce first? And I think that's what the market is trying to figure out.
Well, I think you hit the nail on the head. It's like you tell me where S&P 500 earnings estimates are going over the next couple of months, and I can tell you, or John Butters would be able to tell us where it should trough based on that estimate for earnings. Right now, we still have an estimate of $270 for S&P 500.
That's too high.
So if all these strategists, and we had one on CNBC on the Fast Money last night, if they're lowering their estimate or they're lowering their targets, but they're not touching their earnings estimates, like that's not particularly useful. Like if you want to just take a chart out and throw a dart, like that's probably as useful as that. But if you can say with rates here, with this sort of headwinds to supply chains and increase this, which is going to hurt margins, and this sector is most affected, and yada, yada, yada. And, this is the work that we've done over the last 3 recessions, that this decline in S&P earn, that's the work that should be done before you come out with a target for the S&P 500. So right now, I think Butters' work is so helpful because it puts some guardrails around this. But the last piece of the puzzle, as we get through Q1 earnings over the next month or so, is what are the strategists expecting for earnings? And that brings us to John's work here on the sector front, guy. 5 sectors have forward PE ratios below the 10-year averages, led by the energy sector. 5 sectors have forward PE ratios above the 10-year average, led by financials, consumer staples. Now, this is interesting. This is right in your wheelhouse. The energy at a discount and financials at a premium.
Yep. Well, financial shouldn't be at a premium, and I don't think energy should be at the discount that it is, although that's been dead wrong for me because energy has fallen off a cliff on the back of the commodity. But, I look at the skews and say, man, oh, man, if there's one sector that's still too expensive, I think, or there's too much optimism, I think it's still the financial sector without question. So, look, this is a great thing. You know, folks should sort of have this up and be looking at this, because there's going to be a level where things start to make a little bit more sense. And by the way, this is something that Warren Buffett is probably looking at, along with a lot of other different indicators as well. But there will be a point where this thing gets just too cheap in terms of valuation. And regardless of what's going on in the world, he's going to sort of step in. I just don't think we're there yet, Dan.
Yeah, no
By the
doubt.
way, and that speaks to a poll that Amanda ran. If you want to put the poll up, good for you, Amanda. This is pretty easy. I mean, basically she's saying, is the market going higher or lower? But buy stocks here, that's the 3-question poll. And she did a great job. We're getting a lot of response, but 2/3 of the people say no. So they seemingly are in a bit of our camp right now.
Yeah, I mean, and again, you would expect to see this sort of pessimism, given what we've seen from the markets, the speed in which they've declined, the uncertainty around what's going on with yields. And I can't say this enough. You know, the administration came out and they said, we don't care about the stock market. We're focused on the 10-year yield. And things have gone haywire then, if that's the point, because stocks, and, you know, we don't use this term lightly, they've kind of crashed here, you know, and you were around for the 87 crash. And, you know, people kind of think that, you know, the .com was a crash. It wasn't. It was a slow moving train wreck. It just kept on going and going and going. And, you know, there were definitely like, you know, crashy periods, squeezy things. This financial crisis felt like a crash at times, you know, August, September of 2008. And again, down there, people were really pessimistic. You know what I mean? And then, you know, what happens is when you get those kind of really sharp kind of rallies within a bear market, you know, people basically remain bearish, right? You know what I mean? And they kind of get squeezed. It's hard to kind of see where the bottom is. So again, I just want to pull that up. All right, before we get out of Butter's work done, Guy, one of the things that's really helpful, and this was the April 4th earnings insight blog from Butters, and I think, Amanda, maybe they can kind of pull it up. This is the sort of work that you're going to get in your inbox. We just hit some of the highlights here, but this is great stuff. And, you know, last week he was talking about the growth rate for the S&P 500 is at 7%. We came in on the year, I think it was like 13% expected growth. This is the stuff that you want to keep an eye on, because if you're trying to figure out the markets relative to expectations, and you say it all the time, you know, the lifeblood of an equity market or a stock market should be expected growth, and how closely you kind of get there, and what sort of premium to the market should individual stocks or sectors trade at. All right, you want this in your inbox every Friday morning from John Butters. He is the senior earnings analyst over there at FactSet. You can have his blog. There you go, factset.com/insight/subscribe. All right, we got to get out of here. You want to take 2 quick questions here, guy?
Well, I was going to say from Chris L, and then I do have to go because I'm going to have Peter Bookvar on in a couple minutes. But
one question.
Chris L is saying, this is directed at me, do you think cash on the sidelines is waiting for the Santa rally?
Oh man,
I love
Chris L.
I really love Chris L. I mean, that is fantastic.
That's awesome. All right, so will you please answer that, guy?
You know, you know how many times I've had to sit through listening to people talk about all the cash on the sidelines and the dry powder that the market has is one of the pillars of the bull case. And when the market's going up each and every day, you sort of got to sit there with your thumb up your ass and keep your mouth shut, which is what I typically did. But knowing full well, it's such a bullshit thing to say. You know, it's just a lazy narrative. And now, with the market cascading lower, and I put it out the other night, you know, where are all these assholes with the cash on the sideline now? Because it's just dumb. And Chris L knows that. So Chris is just trying to fire me up. And in terms of the Santa rally, I mean, I just love, that's another thing as well. And is today hump day too, Chris? So you got me on all those things.
See, Guy, you can crack a little bit of a smile.
No, listen, I love the people. They know, listen, I'm a 61-year-old surly MFer. I totally get it. I don't pretend to be anything else. That's just who I am. It's worked for me so far, and I'm not going to sort of get off the track now. But when people say things that are just infuriating, and I know to be patently false or just flat out stupid, yeah, it irritates me.
All right. Before we get out of here, and I'm excited for your conversation with Peter Bookvar, I just want to just kind of lay this out here. Okay, Guy. So the S&P is down 1/3% right now. The NASDAQ's up a little bit because Apple and a couple other names there. All right. You have a VIX at 52. You have the move index up 2.5 at 140, which is up 40% of the year. We just said that tracks the treasury volatility. Okay. And that's at 52-week highs. You have the 10-year yield at 4.2,
No, it's
percent.
higher than that.
Okay. Am I looking at 4.42? Sorry.
4.42, right.
4.42. You have crude oil at 57.25. You have a dollar that's actually weakened despite yields going higher. So the Dixie is at 102.
Not good. How many times have I brought that up?
I know. And then gold up 100, like you said.
Yep.
So that is a really murky, in my opinion, macro snapshot right there. And the longer we kind of stay down here and the leadership's not there, by the way, JP Morgan's down 1.5%, Bank America down 5%, Wells Fargo down nearly 4%, Citi down 3.5%, Goldman down nearly 2%, Morgan down 2%. Not good price action, man.
No.
Like a lot of and listen, we're not trying to freak anybody out. We're just kind of calling it the way we see it, but that's pretty nasty, especially now when you consider the S&P is down 15.5%, down nearly 20% from its all-time highs made in February.
Bond auction at 1. Timmy just texted 61 exclamation point. I have no idea what that is. I don't know.
What is that? What is
61. That? Roger Maris hit 61 home runs in 1961.
61 and 61.
Yeah.
You ever see that movie, 61?
It's an excellent movie.
Excellent.
Really just an excellent movie.
Love it.
I think Billy Crystal was behind that in some way, shape, or form.
Well, he was a big Mets fan, though.
My age. Yes, Timmy. My age. I'm 61. Thank you. What did I say? Rap, Amanda's saying.
All right, peeps. Thanks so much for being here.
Amanda's yelling at me. Timmy's yelling. Everybody's yelling at me.
Listen, if you're watching this and you're not subscribed to our YouTube channel, just hit that subscribe button.
112,000 other people have subscribed.
There you go. And tomorrow morning, Guy's going to be on the Risk Reversal podcast with Peter Bookbar of Bleakley Advisors. We've got a big week for you here. Thanks for being here.